Good afternoon. Today's Friday, the 24th of February 2012, and this is Brian Shannon from AlphaTrends.net. Let's take a look at these markets here. We finished basically mixed a little bit. The semiconductors and the financials were down. Semis got hit the hardest, and that's something to be aware of, not necessarily concerned, but the semiconductors, if you remember, did really start to lead this market higher and, up 13% year to date still. So just in the last 7 weeks, we're still hanging on to some large gains in there, and a little further correction wouldn't be a surprise. But the S&P and the Nasdaq were, finished out at highs for the year once again today. So let's take a look at the charts here, and today's high for the S&P was 137.20, which is important because we did get above this prior high of 137.18 from last year. So we briefly got above that high. If you saw on the blog at AlphaTrends.net, I had put a updated chart of the inverted head and shoulders pattern, and basically this measures out to an objective right about 138 even, and you just take the height of the pattern, add it to the breakout point, and that gives us about 138. Anyways, the S&P 500 did make a new high for intraday, at least for the last several years, as it did get above last year's high of 137.18. Of course, it didn't hold on to that, but the point is we did still see a strong performance for the market this week in terms of the S&P 500. We saw the prior resistance that did hold as support in here. So this level in at about 135.80 will continue to be important next week. And when we break it down a little bit further, you can see that we had a little bit of resistance here and even right at this 3650 level that we got back above as well. So the pattern of higher highs and higher lows is still uninterrupted here. We've gotten a little bit cautious at times, but maintained that this market is innocent till proven guilty. That's still the case here, and I think that really 135.80ish next week is going to be the important level for the S&P 500 to take a look at. We're getting more stretched, but it doesn't mean it can't continue to go higher. That 138, that's not meant as a literal target. It's just meant as here's the potential that this pattern indicated to us. And now that it's getting close to that level and the highs from last year, we just want to maintain a high alert. We always want to keep a very strong defense in the market. That's what will keep you alive. You can't become complacent when we have these nice stretches like we've had this year. There's still danger. I mean, obviously, there's still stocks that are gapping down each day and hurting a lot of people. It was just a couple of weeks ago that everyone was excited about the upside in Gilead Sciences, GILD. This had this huge run. It gapped higher on some news and then just caved in this week. So there is still a lot of danger, and if you're late to the party in these things, it can unwind rather rapidly. The Nasdaq, let's take a look at that. The Nasdaq did finish at a new high also for the last 10 years basically, and it's still kind of zeroing in on that 65-ish level. That's the level we've been talking about for the last several months, and it doesn't mean it will become a brick wall. That's just an area that a lot of people are focused on because it's basically the only level we have to look at that makes any sense in here. We could, I suppose, and I haven't done this yet, but let's take a look together at the Fibonacci off the all-time high for the Nasdaq down to the lows that it saw after 2002. So maybe we're headed up to the $70 level, up towards a 50% retracement. That's something to be aware of. I hadn't actually realized that this was a 38.2% retracement of this bigger decline until just looking at it right now. So sometimes you look at things and they make a little bit more sense. But 65 is just ahead, and that's a potential area where it might encounter resistance. We're still in a fantastic uptrend with these higher highs and higher lows. We've got this trend line, we touch upon it, but it doesn't break. So if we next week are to break below some of these levels, well, today here we broke out past the recent resistance from the last week and a half, and that held as support. So initially next week, about $63.80 we want to see hold. I think a more important level will be down closer to about $63 a share, and we can get a little bit better perspective of that when we kind of back it up like this and see see that 63, 63 and a quarter in this general area, that was a little prior level of resistance. It's held as support as well. So that's the more important level that I think you still give the benefit of the doubt to the buyers as long as we remain above 63. The Russell 2000 still kind of just neutral in here. If we take a look at that 65-minute time frame, we've been observing this range that it's been in at about 81 to $83 a share, 83 and a quarter or so. Drilling down to a 10-minute time frame, you can see it's we're within this range still, and it's kind of just going back and forth. Nothing here yet to indicate that maybe we're breaking down or breaking out. But as I will continue to remind ad nauseum, the fact is, the sideways consolidations through time tend to resolve themselves in the direction of the primary trend, which in this case obviously is still higher. So that's just something to be aware of. The semiconductors, as I said, we had run into some resistance, or into this level that was resistance last year in July. It came up to that level and backed off a little bit. And this week again we were down. What was it? Let's take a look together. We were down 2% in these semiconductors. There's still, I mean, you still look at it though. This is the key level. This is really the higher low that's important in this series of higher highs and higher lows. Hopefully, this will become another higher low, and it can continue to move higher. But we still give the benefit of the doubt on this daily time frame to the buyers, and we look at it and say near term we're a little bit cautious though. On the 30-minute time frame, you can see that we are below a declining 5-day moving average. Now that doesn't mean it's necessarily bearish, because the bigger level of support here at 30 is 34 bucks a share, and 34, as long as that continues to hold, then we're looking at this more as a consolidation through time rather than something that's breaking down. We did, as we know, we've been observing that we did break the uptrend line in here, and it would take a move below 34. If it's stuck below 34, basically what I'm trying to say here is, and I think people get confused about this sometimes, is that when we're in this uptrend, higher highs and higher lows, and we're above all these moving averages that are rising, then we remain positive, and as they start to turn more neutral, like kind of goes from green to yellow in here. It doesn't mean that the breaking of the trend line doesn't say, okay, now we're in a bearish environment. It means now we want to be more cautious here. Perhaps this market needs to slow down and digest these gains, and that's what it seems like with the semiconductors. So we remain neutral to neutral in the near term to positive on the longer term, as long as we remain above that 34 level. Breaking below 34, then we're going to have a little bit more reason for concern, and think that maybe this market isn't willing to continue to cooperate as much as it has on the long side. And these gains just can't continue at this pace. Obviously, not even 2 months into the year, we've got some great numbers year to date. So the financials continue to hold above that 1460 level, and we could still possibly see it head up towards 15 and a half or so. The 65-minute time frame we can see here, we've in this market we've broken the uptrend line here. We spoke about that, and that gave us reason to turn cautious. We've still got a little bit of a range bound market more than anything, defined by about $14.40 up to about 14.90, I guess. So we're really more neutral. We've gone from a nice uptrend. Now the question becomes, is this just some accumulation before it turns higher again, or is this distribution before it breaks down? Well, there's no use in trying really to predict that. We want to listen to the message of the market and the clues it's providing us, and be aware of the key levels, saying that basically if we break down below 1440 and stay below that 1440 for more than a half hour or so, you want to become a lot more defensive. So we're still in a positive environment for stocks. We had 1640 advancing stocks today, 1350 decliners, and it's still a lot of great upside movement, and the stocks that look like shorts turn around and get squeezed. So continue to just listen to the message of the market, keep an open mind, and be prepared to get more defensive if key levels of support begin to break.